making the bear case for the yield curve inversion, we spoke a little bit to how stocks might positively react to this inversion. Now, going to give the flip side of that coin, equal weighted here on both sides of the market, because of course, anything can happen. At the end of the day, one of two things is going to happen, and the first could be that bull market coinciding with the yield curve coming out of its now year-long inversion. Today we're going to look at what a bear market in stocks could look like if the yield curve does eventually uninvert. Historically, the yield curve has always normalized. Does that make this current scenario a necessity that the yield curve has to normalize? No, but primarily we do exist in a normal yield curve. And if history is any indication of that, at some point the yield curve will normalize and short-term rates will be under long-term rates. Now, how we get to that uninversion will have an effect on a lot of different things. That all of that being said, of course, I have to say that we can be inverted we've been inverted now for over a year. We've seen the biggest inversion. We're still at the largest inversion that we've seen over the last 30 years plus, more than 50 basis points of inversion between the 2-year and 10-year U.S. interest rate. But like I say, if we do become uninverted, we do normalize in our yield curve, that could coincide with a bullish stock market or a bearish stock market. And I don't think anything will occur here. This yield curve will not move in a siloed effect without any effect to the stock market. And so let's see, what's this looked like so far? Well, you can see that amid the most recent inversion, stocks have seen some downside. They've bounced back. And like I say, go check out the bull case for stock markets and coming out of this potential inversion. If you want, we're going to look at the bear case today, which I think you have in front of you, right? Historically, we've come out of these inversions where the blue line there, the difference between the 10-year and 2-year U.S. interest rate has gone from negative back to positive, has coincided with stock market crashes. And this is where you get that old adage of, historically, yield curve inversions have coincided with stock market crashes. And a lot of people think it's just a matter of time that the stock market will crash. But of course, the rebuttal to that is markets are so efficient that if a yield curve inversion necessitated a stock market crash, it would have already done so, right? So it doesn't necessitate it, but there is a historical correlation between bear stock markets and yield curves of emerging from yield curve inversion to normalization. And this is what it's looked like. And this is also the case, the potential case for a bear market coming out of this inversion. Historically, you've seen that blue line, the 2-year interest rate, climb up and surpass the orange line, the 10-year interest rate, with interest rates on the whole moving higher. And this most recent occurrence of a yield curve inversion, no exception. You see that blue line climb up and surpass the orange line. On the flip side, historically, you've seen the uninversion occur by short-term rates being lowered. You see that blue line coming crashing down, which doesn't have to be the case, right? We could normalize by that orange line climbing higher than the blue line, essentially interest rates on the whole moving higher, but the normalization being the 10-year climbing higher than the 2-year. Historically, though, this hasn't been the case. What's been happening historically is some catalyst for the stock market at large moving lower, and the central bank, the Fed, the U.S. central bank, coming in and saying, okay, the economy is moving in the wrong direction. Stocks are down 20, 30, 40%. We're going to bring short-term interest rates down to either near zero or 0%, like we saw after the financial crisis in 07, 08. And the yield curve normalizes because short-term rates come down to near zero and medium and long-term rates stay relatively higher. Just a quick You see that in the 2001 to 2004 range, short-term rates, the 2-year comes all the way down to 0%, and the yield curve normalizes. Same in 2007, 2008. Interest rates in the short term come all the way down to 0%, and 10-year interest rates move lower as well, but not by as much. And you see that normalization. Will the catalyst be bank stocks? We've already seen some downside. We've seen them bounce back a little bit and some of the fear dissipate, but this is an example of what it could be, right? And in the early 2000s, it was dot-com stocks and the dot-com bubble. In 2007, 2008, obviously, it was the financial crisis there. And I mean, not too far off. Obviously, it's always a different story. It's never going to happen the same way twice. But similarly, you're seeing financial stocks having a tough time with this interest rate environment here. It's funny, and this is why we hammer on so many of these different ideas and tie in interest rates to the stock market and interest rates to foreign exchange to the stock market and commodities and everything else, because nothing really happens in a vacuum in our economy. And I don't think it was any coincidence that interest rates shoot up higher. You see there from 2004 to 2006, short-term interest rates shoot up higher. We get that inversion in 2006, 2007. And then soon afterwards, a certain part of the stock market finding issues. Oh man, we actually didn't see this coming or didn't see this. A bubble bursts. And it's because higher interest rates can really put the magnifying glass on all companies, all sectors of the stock market. And that's when you tend to find some of those problems. And we've seen a little bit of that with these regional bank stocks, right? They've fallen on a duration mismatch, which is essentially they've locked up their money getting around, let's say, a 2% interest rate for the next 5, 10, 30 years. And now as interest rates have moved higher, people want that money. And it's like, okay, well, let's go look at accessing it. Oh, now interest rates are 4, 5, 6%. Yikes, we have to either take a huge loss on this money that we have locked up, or we have to borrow funds at 4, 5, 6%. We've mismatched our durations here, and we've got a big risk on our books. And that's why you've seen the downside here. Again, interest rates being higher definitely brings stocks, all stocks, technology stocks, you saw some downside in 2022, brings them all under the magnifying glass. And it's when you tend to see some of the flaws in certain sectors. We've seen some of it in regional banks. The bear case is inflation stays higher than expected. Interest rates stay higher for longer. And we have further looks at stocks, or just this one problem that we've seen here in bank stocks gets worse potentially, could have this effect of, certain stocks trying to access money and liquidity via those banks. They can't do that, and the whole market crashes here. It really becomes, to what extent are there problems? Like I say, when you put the magnifying glass on and you see some flaws in some of these stocks that you maybe didn't see in a 0% interest rate environment, how bad are those flaws? And that'll be the difference between a bull and bear case in this higher interest rate environment. Making the bull case for yield curve inversion, and it might feel like a tough one, because right off the bat, you might say to yourself, Frank, all I've ever heard about yield curve inversions is that they've coincided with stock market crashes. Now, before we get to that, I want to quickly let you know what technically we're looking at here, and how drastic it might seem, but how in the broad scope of things normal it is to get a yield curve inversion once every 10 years or so. We're looking at data from 1990 to now of the 10-year interest rate in the US, subtract the 2-year interest rate in the US. And given a normal yield curve, you would expect that difference to be positive. 10-year rates, longer duration, higher interest rate than the shorter duration 2-year interest rate. When the yield curve is inverted, so to speak, that means that that difference is negative, whereby short-term rates are actually higher than longer-term rates. You can see that that occurred in the early 90s, that occurred in the early aughts, that occurred in the late aughts, and it's been occurring for about a year now. Historically, the yield curve is always normalized. It's always uninverted. It's always come back to positive territory. Does that mean that it has to? No, but this is something that there's considerable historical data leading to the reversion to normalcy, so to speak. But we can potentially stay inverted. I mean, we've been inverted for about a year. We right now are more inverted than we've been in the last 30 years, as you can tell, at negative around 100 basis points. The most inverted we were before this recent one was negative about 50 basis points. And we were only inverted historically for a couple of weeks to a couple of months, and we've been inverted for a year. So this is definitely a longer one. It's a worse one in terms of how far we've gone inverted. But historically, like I say, have come back to normal, and you know, in all likelihood would, but anything is possible. Now, roping in the stock market here, you'll get a little bit what I was talking about to start. Uninversions, returns to normalcy of the yield curve in the US have coincided with stock market crashes, bear markets, whatever you want to call it. You'll see that the inversion of the early aughts coincides with that dot-com crash. The inversion of 2006, around then, right before the financial crisis of 2007, 2008. And then our most recent one, what's interesting is we haven't seen a crash in the last 12 months, but we did see considerable downside in the stock market around the same time that the yield curve went inverted. Was it to the tune of, 40, 50% like we saw in these previous crashes? No, more like 20 to 30%. But, downside nonetheless in the S&P 500, NASDAQ, Dow, and Russell. And now the question becomes, how are we still inverted? If anything, kind of in the most recent 6 to 8 months, gotten more inverted. And the stock market has been able to bounce back and actually get close to those all-time highs that they put in prior to this inversion. And like I say, the 2022 bear market that we saw. Why are stocks so comfortable with what Frank just told you is the worst inversion in 30 years, and potentially more than that? We've got data going back to the early 90s there. As you can see in that red box, the blue line, the yield curve, the 10-year minus the 2-year, going from, 0 to negative 50 basis points to negative 100 basis points, negative 100 basis points 2 different times this year. And amid all of that action, the stock market bounces back. And like I say, is, especially within the NASDAQ and the S&P, a couple stones throw within all-time highs there. What's been occurring is actually kind of context for a potential bull case scenario for this seemingly inevitable, historically inevitable, might be a better way to say it, return to normalcy, uninversion of the yield curve. What we've been seeing is inflation has come off considerably since the heights that we saw in the later part of 2022, and when we started to see that yield curve inversion as short-term interest rates spiked to try to fight this inflation. And so if we continue to see this inflation that you're seeing there at the top come off close to that 2% target the central bank likes, then that could be reason for interest rates. As you can see here at the bottom graphic, the projection for 2025 is for interest rates to be around 4%. We're, at 5.5% right now. And so if inflation can normalize, if interest rates can come a little bit lower as the Fed and the interest rate projection that's in front of you, that's a short-term interest rate. That's as short-term as it gets. If that short-term interest rate comes lower because inflation is normalized down to 2%, interest rates can get down to 3.5%, 4%, and the central bank gets the soft landing that Fed Chair Powell's been talking about, then you could have the yield curve uninvert, so to speak, and you could have the stock market not necessarily crash, potentially even feed off of lower interest rates on the whole, because historically, and we'll get into this in the next segment, the bear case for the stock market, given a return to normalcy in the yield curve, historically, what we've seen is interest rates in the short term fall to 0% coming off of the stock market crash, and those two things kind of happening simultaneously, and that's what's caused the yield curve to uninvert, right? Short-term interest rates were higher than long-term interest rates in early 2000s, in 2006, 2007, and then when the market crashed and the central bank lowers those short-term interest rates, the yield curve uninverts. Now, we could potentially see a stock market still in a bull run like we've seen, or even just not crash if inflation falls down to 2%, give or take 100 basis points. Interest rates in the short term from the central bank normalize lower a little bit, closer to 3 or 4%, could get that uninversion. And stocks, especially tech stocks, could like those shorter term interest rates being lower, yielding more growth in those growth stocks. So it'll be interesting to see. It's especially interesting because we're in the midst, even though we just hiked 25 basis points at the most recent FOMC meeting here in the US, we are kind of in this cycle. This is definitely what the central bank wants. The soft landing, inflation down to 2%, bringing interest rates lower to 3-4%, and the stock market not to crash. But we'll see how it all plays out. We're at a really interesting inflection point where a lot of people think that this was the last interest rate hike, and you could see interest rates moving lower and get that yield curve to come out of inversion without necessarily needing a stock market crash. Why bank stocks love and hate high interest rates. Definitely a love-hate relationship the last 12 months as interest rates have climbed to their highest in years. And it's been really bad at points for tech stocks and the bulk of the stock market as inflation was climbing to new highs in the later part of 2022. And we were wondering how high interest rates were going to get. And there was just a lot of fear, a lot of unknowns that really brought the market in general down. But now the dust has settled a little bit. There's less fear around inflation and everything, but there is a growing sentiment of interest rates might be higher for longer. And the financial sector, in my mind, has been the most wishy-washy, kind of sensitive to this idea than any sector, even more than tech stocks, which you might have thought were the most sensitive to higher interest rates. It really has been financials. And first, a little bit of context. The 10-year just this week returned to 4%, which in the terms of this chart, doesn't seem like a big news. And you might say, well, the Fed has already hiked past 5%. Why is this relevant? Well, the idea that this milestone is conveying is that interest rates might be higher for longer. The Fed hikes overnight interest rates, and the idea the market has been conveying over the last 12 or so months is that, yeah, they're going to hike this short-term interest rate, this overnight rate, up to 5%, maybe even 5.5%, but they'll probably bring it down in the next 12 to 24 months. That timeline's being pushed out further and further, and now 10 years down the line, that duration is shifting higher as well, as there's a growing sentiment that inflation, maybe we've already hit that peak, but inflation might stay higher than 3, 4, 5% for longer. Maybe it doesn't get back to 9%, but it stays in this higher than the central bank wants it for a longer period of time than a few months to a few years. And so on the face of it, if you read a textbook, this is a good thing for the financial sector. When interest rates are 0%, and you're, a bank or a brokerage or a mortgage house or whatever, you just have less flexibility. You have less, theoretically, profit potential at 0% interest rates, because everybody's being really competitive around 0%. Whereas if interest rates are 3, 4, 5% and potentially climbing, there's a lot more, leeway for this place is offering 4%, this place is offering 5%, and you're able to build in a couple of basis points on top of that as well, as you'll see, with the Fed's overnight interest rates at 5.25%, and the 10-year at 4% here. 10-year mortgages aren't necessarily at 4 or 5%. They're not even necessarily at 6 or 7%. They're climbing higher. And so, again, theoretically, this should, all else equal, be a good thing for the financial sector. And in the last couple of years, financial sector is up 25%. But you'll notice it hasn't been a direct relationship of, over the course of the last couple of years, interest rates go from 0% to 4 or 5%, depending on what duration you're looking at, and financial stocks moving higher. There's been some turbulence. There's been turbulence as recently as March, which we'll get to here in a second, because it hasn't necessarily been a straight shot higher for all interest rates. Of course, we have one benchmark, which is the U.S. Treasury, and where they set interest rates here relative to where the Fed sets their overnight interest rate. But remember that the Treasury has 1 month bills, they have 6 month bills, they have 1 year and 2 year and 5 year and 10-year notes in the 30-year bond. And the curve has been inverted for pretty much the last year, which has really been complicating things. So what are we looking at here? The difference between 10-year and 2-year rates has been negative for the last 12 months or so of trading. And this inversion can really complicate things for these different financial entities. And it's really been complicating things for regional banks. You'll remember the story that broke in March, and you can take a look at the chart and the significant drop in regional banks, where they went from being positive for the last couple of years to being down over the course of the last couple of years, and still down about 5% in that same time frame of when the U.S. has been raising interest rates. The financial sector at large, and that's a lot of larger cap stocks like American Express and Morgan Stanley and Goldman Sachs and everything. Regional banks being smaller cap regional financial stocks, hence regional banks, not even positive in this time frame. And bringing you back to this story here in March, the banks were dealing with something very close to this inversion here, which was a debt duration mismatch. Essentially, they were taking in money from different private institutions that wanted to park their cash with them. And then as interest rates started to rise, they were like, oh, well, lock in a 2%, 3% return on this capital using the risk-free U.S. Treasury debt for 5 years or 10 years or what have you. Inflation spikes even further, short-term rates skyrocket. And now if any of these institutions are coming to get their cash, because cash is getting tighter, obviously, higher interest rates, more constricting economic activity, cash is more valuable in a time like this when interest rates are rising. Well, now they're getting 3% with the cash that's locked up for 10 years. which is risk-free if they are able to have enough liquidity to supply these institutions that are coming in saying, hey, we want this cash today, or in the next week, or in the next month. And if they have to now, one, sell out of that position, they're long that 10-year debt for 3%. Well, now that it's at 4%, or if they were even, a lot of these institutions locked in at under 2%, they're taking a big loss on that to free up capital. Or if they have to access money in the short-term rates are so high. You've got this inversion that we just talked about, because short-term rates are 4, 5, 6%, and they locked in a lot of their the cash that was coming in from these institutions. Thought that they were doing it smartly at a higher interest rate 5, 10, 20 years down the line, but didn't foresee this rise in interest rates. So a classic example of, theoretically, in terms of textbooks and everything else, interest rates should be good for the financial sector. But this story really did drag down the large cap financial stocks as well. They saw considerable downside around this in March, and they've been a little bit more siloed off from the story than regional banks have been. But a classic example of what plays out in the market is rarely going to be what happens in those textbooks, and seeing a little bit of the love and hate relationship between the entirety of the financial sector and higher interest rates. Without getting too into it here, there's no coincidence that a lot of times you'll see a yield curve inversion coinciding with the stock market crash, because higher interest rates not only have the direct effect of reducing the potential for growth, right? If money's more expensive, tech companies, these growth-oriented companies, have a harder time accessing cash to fund their growth. But also it can just really, higher interest rates and a yield curve inversion like we're seeing can really throw different parts of the market for a loop, can really create complications you might not have seen coming here. And you can see, since this story broke here in March and the last couple of months, the correlation between bank stocks and interest rates have gone from being, positive 0.5, positive 0.6 correlation to now nearing negative. And you can see that the relationship on the whole over the course of the last couple of years between bank stock prices and the 10-year interest rate has not been a net positive one. They've had a negative correlation for a stretch when inflation fear was really cooking in the fall and winter of 2022 going into 2023, where higher interest rates were just coinciding with fear and coinciding with stock downside. And now, getting close to a negative relationship as well here in 2023, whereby, and we're seeing it play out actually in the last couple of days of trade, higher interest rates potentially creating a bigger problem for these bank stocks that have duration mismatches and some of these other problems. So we'll see where it comes from here, a much more nuanced situation than you might read about in a textbook. Higher interest rates being good for some financial sector companies, but for the time being, getting close to a negative correlation between interest rates and bank stocks. We'll see where it goes from here of inversion.